The Great Depression of 1929 started where all the financial disasters starts, the United States of America, because of the scale of the economy at which it operates, that any disruption can cause global outage. Now, in short, 1929 crisis was the stock market bubble, but in detail, this was what happened. There were huge technological advancements that were made in the early 19th century, and the end of First World War in 1919 gave the world room and time to imbibe it. So a period of peace and prosperity embarked in 1920s. This period is also called the Rolling 20s in USA. People were rich, people were becoming really rich and had spare wealth to put on other things. And the place people fancied was the stock market. There was a new wave of interest in corporate bonds. And three major things happened. Number one, people started taking loans from banks just to buy stocks, as the price was literally doubling in 2 years and they could make profit even after paying all the loans. Number two, investment banks, and all the major financial institutions started heavily investing in the stock market. Number three, margin investing was on the rise. In this, you are given a leverage by the stockbroker so that you can buy more stocks than the amount of money that you had put. For instance, if you had put $1,000, you can buy the stocks worth $10,000. So you could end up with more profit. Due to the presence of powerful people and corporations in Wall Street and the hesitance of the government to interrupt in those markets led the stock market boom to become a stock market bubble. Price speculation, rigging, manipulation, all of those things were there. The market price of the stocks were way higher than the actual intrinsic value of those. Still people were buying those stocks because the corporation were pumping a lot of money into the market to keep the system as it was. Warnings were given by the people like Paul Warburg, but they fell on deaf ears, and hence the doomsday came. On October 24, 1929, aka Black Thursday, millions of shares were sold. It is speculated that influential players had already exited the market, which triggered this crash, but it is still doubtful to this day. In the next following days, more and more shares were sold, which led to a high-level meeting at JP Morgan office between John D. Rockefeller, Richard Whitney, who was the president of JP Morgan at the time, and the president of Wall Street, Thomas Lamont. This meeting was held to inject $250 million into the stock market to keep the situation north. But the situation went haywire and the stock market lost 35% of its value in a very short span of time. Actually, what happened was when the stockbrokers saw that the price of the stocks were falling, they called the people who took loans, leverage to buy the stocks, and asked them to repay the loans. And most of the people were not able to pay back the loans, and hence stockbrokers started selling the stocks to gain back their money, which resulted in the selling of a large amount of stocks on subsequent days. I would be explaining in another video that how do people lose money in these situations in stock market, but for right now let's just accept the fact that people lost a hell lot of money. Investors lost a lot of money. Banks and investment banks and all the financial institutions lost money, and these things caused three major repercussions. Number one, the banks, when they lost money, because they now could not get back the loans that were given to the people because they were also bankrupt, and also bank directly lost money because they had also invested in the stock market. These things caused a lack of confidence among the people that their money was safe in the banks, and hence bank runs started. 3,000 major banks closed in USA. And this is the biggest factor that contributed to the Great Depression as we know it. Number two, when investors lost money, businesses were shut down. When businesses were shut down, people lost their jobs. Unemployment was on the rise. And third thing, the capital froze in the country. There was no money, there was no liquidity, and hence it caused more business failures and unemployment.
To mitigate the crisis, the United States government increased the tariffs for European countries so that the local producers gain a little bit more of capital, but that had an opposite effect. as the European countries also increased their tariffs towards US. So it meant that it was more difficult to export the good to Europe, and that created a further liquidity crisis and increased unemployment across the country. The European country that was most affected by this crisis was none other than Germany. United States used to provide loans to Germany so that it could pay for reparation of World War I, and now loans were no longer available, and hence Germany was facing a tricky situation, so it started printing more and more currency, which eventually resulted in erosion of German currency to a value of nil. You have seen people lining with a cart full of money just to buy slices of bread. That was the situation there. Nevertheless, whole Europe was in turmoil, and United States and Europe being in the center of Industrial Revolution meant that their downfall would result in a global economic crisis, and that was what happened and what we know as the Great Depression of 1929.